Nell and Monique have been really instrumental in supporting us in the past, as well as guiding us in making key decisions around any upcoming issues. Many of you would have attended our 2021 year-end presentation in March, as well as the voluntary update at the end of May. Today's update will just begin with Ian sharing insights onto how we progress the execution of our strategy. Casper will then talk to our performance and provide you with valuable information on any upcoming issuance that we are contemplating. We will then allow for some time for questions and answers. And given this is a virtual platform, we will allow questions to be asked during the presentation, but only via the chat box on the right-hand side of your screens. Please feel free to use this functionality at any point during the meeting. Alternatively, at the end of the presentation, feel free to use the raise hand tool available on your screens to ask your question via audio. To avoid multiple questions being asked at once, please allow me to confirm that you may proceed to ask your question prior to you commencing with the question. Please also keep yourselves on mute for the duration of the presentation, unless when asking a question. And we hope that we'll be able to get to as many of your questions during this presentation as possible. But in the event that we're unable to, we will provide you with the response in the next few days. So starting off today will be our Chief Executive, Ian Williamson, followed by Casper Trusky, our CFO. Over to you, Ian.
Thank you, Cesare, and good morning, everybody. Thanks for your time this morning. Since the beginning of the year, we've experienced continued momentum in our key focus areas of rectifying, simplifying, and amplifying our business. Before I share the detail, I'll begin with a quick recap of our strategy. So our truly mutual strategy can be understood through three primary components. The first is our vision, or our victory condition, of becoming our customers' first choice to sustain, grow, and protect their prosperity. The second leg is our execution framework, which is the how of our strategy, to rectify, simplify, and amplify, which breaks down long-term ambitions into shorter-term tactical steps that will allow us to reach our destination and deliver on the commitments we've made to all of our investors. The third leg is our value drivers, which focus on the what, the tangible outcomes we will deliver for shareholders of revenue growth, operating margins, capital efficiencies, competitive strengths, and execution and delivery. Our implementation of ESG principles across our dual roles of both asset owner and asset manager is moving at pace. Apart from preserving the planet for future generations, we have a fiduciary duty to ensure the sustainable continuity of our business and protect our stakeholders' interests. So moving on to looking at our KPIs, this is at the end of the first quarter. For the first quarter, life APE sales grew 19% year on year as momentum witnessed during the last financial year continued into the quarter. We saw improved productivity, increased sales volumes in most products, and a shift in the sales mix, which we believe will be positive for margins. Management continues to focus on improving the pipeline and converting that pipeline into corporate deals, particularly in both our corporate business in South Africa and in the rest of Africa. And across the group, I'm encouraged by the activity we've witnessed in the first month of the second quarter, as sales momentum and productivity held up well, even allowing for the effects of the floods in KwaZulu-Natal and the large number of public holidays that we always have in April. Our value of new business grew as issued sales in the Mass and Foundation cluster grew, and we secured new corporate business in our rest of Africa business. We achieved an improved VNB margin over the quarter. The decline in gross flows was driven mainly by lower inflows into our investments business. And informing this was a non-repeat of large new mandates from the prior year. The outlook for flows and net client cash flow in investments remains good, with a really healthy pipeline. The negative net client cash flow of 5 billion rand was impacted by the decline in gross flows. These were, however, offset by lower terminations and reduced mortality claims across our life businesses, particularly in personal finance. There was a pullback in funds under management as markets and the rand signaled what was to come in the second quarter, with major central banks, particularly the US Fed, embarking on hiking cycles and reducing balance sheets. This we expect will contribute to a level of volatility, particularly in equity markets. However, compared to prior year, funds under management have grown in both our investments and corporate businesses, and this has supported growth in asset-based fee income. We expect that the sale of a stake in future growth to the African Women Chartered Accountants Investment Holdings at an OMIG level will contribute positively to win rates of new business and to defending existing mandates. This momentum will receive a further boost from a group-wide proposed Bula-Tsela BBE transaction, as the overall black ownership of OMIG business will improve to over 51% once this transaction is approved by shareholders. Loans and advances declined in the first quarter, but this outcome was driven by tightened lending criteria and lower disbursements across our rest of Africa business as a result of a tougher overall economic environment and increased competition in some of our markets. And finally, gross written premiums grew by 8% from the prior year, driven largely by higher renewal rates and business acquisitions in the corporate and retail channels in Kenya and Uganda. This was supported by higher premiums in the retail division of Old Mutual Insure. We've seen a further strong recovery in business over the quarter. Let me share an update on how we've delivered against our commitments to investors. I promised that we were going to change the trajectory of our customer experience, and much improved customer ratings show that we are delivering on this commitment. We said we would build a new financial services business. We are well on track, with the Nedbank unbundling being a part of this process, together with the introduction of the new Growth and Innovation Office headed by Vuyo Parker. We promised that we would realize sustainable cost savings, and we are well on track to meet our target for the end of this year. We undertook to regain competitive advantage in the Mason Foundation cluster, and I think you will agree that the numbers show that this is happening. I said that we would re-energize our customer and advisor experience in both our personal finance and wealth management businesses, and the palpable energy in these segments has translated into pleasing numbers. I committed to do all we could to improve the performance of our investments business. Here again, we have indeed improved performance against peers and against benchmarks, against 1, 3, and 5-year time horizons, compared to where we were a year ago. And finally, while the digital landscape is constantly shifting, and our journey will never truly be complete, we are certainly delivering on our promise to embed digitalization into our business. We have 4 key focus areas at the moment. The first is to ensure we remain on track to meet our 2018 listing empowerment commitments. As I said earlier, Old Mutual Investments has sold 21.2% of its stake in future growth to African Women Chartered Accountants Investment Holdings on arm's length pricing terms. The proposed Bula-Tsela BBEE transaction will result in an approximate 4% further increase in the black shareholding of Old Mutual. This is part of a phased implementation of our strategy to achieve best-in-class empowerment credentials for the entire group. We continue to pursue our ambition of expanding our transactional capability in phases to ultimately be at scale. This will continue, and we will update you on our progress in due course. Old Mutual Protect has done exceptionally well in the retail risk market, but it does need to be further embedded. We will endeavour to replicate its success in launching a savings and income proposition to the market. And finally, we launched a new growth and innovation office last year to focus on our aspirations, both internally and with multiple partners in various industries and sectors to drive longer-term growth. The Old Mutual of 2022 is substantially rectified. It's certainly a lot simpler than it was only a few years ago, and we are already starting the amplification process. With that, over to you, Casper, for the financial review.
Thank you, Ian, and good morning, everyone. Today, I will provide an update on our performance and share information on the subordinated debt issuance that will take place later this month. Over 2021, we saw a positive trajectory on key metrics relating to earnings, capital, and value. And we have also seen improvement on prior years across a few of our KPIs and underlying metrics in the first quarter of 2022. In terms of earnings, in 2021, there was a strong recovery in results from operations on a pre-COVID-19 basis as a result of sales and flow recovery in the segments. There were also 1.4 billion once-off items included in this result, including the release of CGIC reserves, once-off benefits and credit charges in Old Mutual Finance, and benefits related to the continued optimization of our risk product hedging strategies. Adjusted headline earnings more than doubled in 2021, benefiting from results from operations growth, as well as a substantial increase in the shareholder investment portfolio return across the group. In terms of capital, our return on net asset value improved to 9%, and excluding the direct impacts of COVID, was estimated to be 13.6%, which is within our target range and ahead of cost of equity. The final dividend of 51 cents was declared at 1.51 times cover relative to adjusted headline earnings. The dividend was supported by high levels of free surplus generation, as well as a strong balance sheet, with the life company's capital ratios in the upper end of the target range. At year end, the value of new business was substantially up to just under 1.3 billion on the back of strong volume growth and acquisition efficiencies. The value of new business margin recovered from 1.1 to 1.9%, just below our target range of 2 to 3% at the end of 2021. All of this resulted in a 5.9% growth in group equity value, excluding the impacts of the Nedbank unbundling. As mentioned by Ian earlier, the value of new business margin improved to 2.8% at the end of Q1 2020, largely due to sales growth in MFC, as well as additional business secured in rest of Africa. Ian provided insights on the key performance earlier in the presentation. Overall, we are pleased with the financial performance in the first quarter of 2022, and I will now share additional insights on the first quarter performance. Results from operations were marginally ahead of the prior year, mainly due to the improved mortality profits in personal finance, being partially offset by lower underwriting results in Old Mutual Insure and Old Mutual Corporate, as well as an increase in central expenses due to our investment in digitalization and innovation activities. In our South African life businesses, COVID provisions were raised at 31 December 2021. The size of the provision was based on our own claims experience, South African Medical Research Council's excess mortality data, as well as an assumption on vaccination hesitancy. The impacts of Wave 4 were well within provisions raised, and no further provisions have been raised. We release the lower of actual experience and planned provision during the first quarter and continue to monitor our mortality claims experience closely. And we will look at the adequacy of existing provisions at the half year. Our capital position remains strong, with the OMLACSA solvency ratio at 200%, towards the upper end of the 175% to 210% range. And the group remains well capitalized within our target range of 170% to 200%. April floods in KwaZulu-Natal has impacted our clients, and to date we have received over 2,200 claims relating to this catastrophe. We provide support to clients and will settle all valid claims. Currently, we estimate that the April floods will have an impact on our mutual insurers' 2022 financials of between 100 and 150 million after allowing for reinsurance. We are also currently reviewing our claims pattern for the recent second wave of floods in KwaZulu-Natal in May and will provide further updates in due course. Rising inflation and interest rates and uncertainty around the Russia and Ukraine conflict continue to dampen consumer sentiment. We monitor the impact of the dampened consumer sentiment on our business, and we are confident that our strong balance sheet will enable us to remain a certain friend to our customers in uncertain times. With all these uncertainties, let us assess how we are on track to deliver on our medium-term targets. We remain on track to deliver on these targets, and in summary, we have seen a strong recovery in results from operations and adjusted headline earnings before COVID impacts, and improvements in our return net asset value to be closer to our cost of equity, with the pre-COVID return exceeding the cost of equity. In Q1 2022, the VNB margin moved to the upper end of our range, and we're very pleased with that trajectory. Both OMLACSA and the group solvency ratio remain strong within target ranges. And finally, we are delivering on our promise to meet the 750 million of annual run rate cost reductions by 2022. But overall, there is still hard work ahead, with downside risks being elevated. We are pleased to announce the OMLACSA plans to issue up to 1.5 billion Tier 2 subordinated debt before the end of June 2022. The slides that follow will provide you with insight on the issuance. I will start by providing an overview of our debt program. We have a 25 billion Old Mutual consolidated DMTN program. The program allows for OML, OMLACSA, and Old Mutual Insure to issue listed subordinated debt, and for OML to issue senior debt. Looking at the level of debt issued under the debt program, at the start of the year, OMLACSA had 8.25 billion subordinated debt in issue. 409 million was redeemed in March, and a further 568 million will be redeemed in September. We plan to issue up to 1.5 billion OMLACSA subordinated debt by the end of June. Old Mutual Insure also has 500 million in issue. Although OML has not issued debt, but is the guarantor of the 3 OMLACSA subordinated bonds with a nominal value of 5.5 billion, it will also be the guarantor of the OMLACSA bond issued later this month. OML and OMLACSA have strong credit ratings from S&P Global Ratings. OMLACSA does not have an external credit rating. There is sufficient capacity for OMLACSA to issue subordinated debt under the program, and we have also received approval from the regulator to proceed with this issuance. Our capital strategy requires that we raise subordinated debts to optimize the capital structure and reduce the weighted average cost of capital. We aim to issue subordinate debt at a defined level with a 5-year tenor to create a smooth maturity profile over time. This profile is expected to smooth out after 2025. We continually monitor our debt metrics and ensure that the level of debt remains within the OML target gearing ratio range of 15 to 20%. We'll look at more detail on the next slide. This year, we have regulatory approval to redeem 977 million of OMLACSA subordinated debt, and OMLACSA will have 8.7 billion of subordinated debt at the end of 2022 if we were to raise 1.5 billion later this month. We also hold sufficient liquidity in core liquid assets to meet the coupon payments and maturity proceeds in line with the Prudential Authority requirements. S&P Global Local Credit Rating is ZA capital A plus for the OMLACSA subordinated deferrable notes. Looking at the key metrics that we monitor, as mentioned earlier, OML and OMLACSA are well capitalized. The level of debt is comfortably within the target gearing ratio range of 15 to 20%. The weighted average coupon rate has reduced as the cost of the subordinated debts issued from 2019 onwards were lower than the notes issued in earlier periods, as interest rates had reduced over time. Relative to last year, the base JBAR rate has increased. Interest cover of 15.4 times increased over the year, reflecting the currency improvement in adjusted headline earnings before tax, non-controlling interest and finance costs. We are comfortable that the level of subordinated debt is suitable and in line with our capital strategy. Before looking at the terms of the upcoming issuance, this slide table provides you with a view of the key information of all our subordinated debt in issue. There is a mix of fixed and floating rate notes, and the coupon rates have varied over time. The terms and conditions of all bonds are aligned, and OML 11, 12, and 13 have OML guarantees to meet regulatory requirements implemented in July 2018. The key terms for consideration for this issuance are: we plan to issue up to 1.5 billion Tier 2 subordinated debt capital in June 2022. The note will be issued under the debt program and will be listed on the JSE. We are looking at a floating rate instrument. The note will have a 5-year tenor with OML as the guarantor, and this will ensure that the debt is priced well and is classified as solvency capital. The credit rating remains strong. S&P Global Ratings affirmed the credit ratings of OML and OMLACSA in May after the outlook of the SA sovereign was upgraded to positive. S&P have also assigned a pre-sales rating of ZA capital A plus to the planned issuance, and this is aligned to notes in issue that have the same terms and conditions. OMLACSA will redeem 977 million in 2022, as previously explained. The subordinated debt will be raised by a Dutch auction, and date and price guidance will be shared closer to the auction date. As mentioned earlier, the balance sheet remains resilient and the gearing ratio remains within the target range. Important dates to consider after today's session are: We will, post today's virtual deal, we will engage with investors that have requested one-on-one sessions with management on the 8th of June, and will provide additional information if needed. S&P plan to release the pre-sales credit rating for the planned issuance today. The updated terms sheet with pricing guidance and the pricing supplement will be distributed around 13 June 2022, and the Dutch auction will take place on 20 June 2022 with a settlement date of 23 June 2022. We look forward to your support and are happy to address questions related to this issuance. Over to you, Sizwe.
Thank you, Casper, and thank you, Ian, as well, for the presentation today. I'm just looking for indications maybe from our tech team if I could be missing something on the chat, but I don't see anything yet in the chat. And I also would like to invite all the investors to ask their questions either via chat or by using the raise hand functionality if there are any questions. So let's give that a few moments. Okay, I see a hand, and that hand is from Portia. If you can please go ahead. If you can just announce yourself, which house you're from, and then proceed with your question.
Thanks, Sizwe. My name is Portia from Stanlib. I just have two questions. First question would be on the COVID provisions. So how much of that have you utilized this year so far? I know you did note that you have about 2.9 billion as of December. And then my second question is on the covenant bridge that you noted in the financials for December 2021. So if you can just give us a bit of color on that USD covenant bridges, why did that happen and what measures do you have in place for that?
Casper, do you want to go for that or hand it to the team?
Can Martin answer the covenant debts? Thanks.
Martin? Just Martin. Yeah, I don't know if I can.
I'm on the line. Sorry, I just had some technical difficulty.
No problem at all. Cool.
The covenant breaches within the relevant entities, I mean, have been existing for some time. It has been something that we've been working with in-country teams from a group perspective, and the ultimate driver, without going into specific details, are just the in-country situations with regards to currency depreciation, as well as work that's been conducted on the business strategy itself of the various entities. There is a current larger project underway with regards to balance sheet restructure, specifically in geography, which we then aim to address the current issues. At this stage, our management of the breaches basically include continuing discussions with the underlying lenders, and which has been the case since the breaches have occurred, and we aren't at risk of any liquidity calls on the breaches themselves from a group perspective. It is a bit of a longer term strategy for us to work them out, but at the moment we do feel the risk is contained, and we are confident in our plans in order to not only address them but to resolve them in the near future.
Just on the first question, we haven't disclosed exactly what the movements in the provision were. So what we have said is that the excess deaths that we experienced in the first quarter were well within our assumption set, and that we've released the lower of actual excess deaths and sort of the planned release. So and we'll have another look at the provisions at June. But at this stage, what we're saying is that the excess death experience has been better than what we assumed at the year end.
Thanks, Casper. Portia, I do note you. I just note that Andrew McPherson, Balance Sheet Management, also wants to contribute. So maybe before we get to your follow-up. Andrew?
Yeah, sorry, Cesar, I just want to make just a note on the covenant breach, which Martin alluded to. So obviously those covenant breaches are in our African businesses where we do have capital flow issues. We have engaged with the lenders. There are technical defaults. We have engaged with the lenders, and the lenders are comfortable with the position. And the one thing I don't know if Martin mentioned, but we also do have a multi-currency facility in place in Africa. Should the lenders become nervous, we can cover that. Thanks.
Thanks. Portia, back to you.
Thanks, Cesar. Yeah, because I just wanted to follow up on those covenants. No, you haven't shared the details. Is it possible to share the details with us just so we know what these covenants are, or is it information that you can't share with us?
I think we can share whatever we've disclosed publicly. We can share with you in the financials.
Yeah, I'll have a look at the financials. Right. I think that's where all the detail would sit. That's fine. We can get that to you. Thanks.
Thanks, everyone.
Thank you. I don't see any other hands. Andrew, if you can please put your hand down. And then are there any questions that people prefer to write on the chat? I also don't see any questions on the chat. So we'll give it another moment or two. Are there any other questions for the team? Yes, Portia, please go for it.
Thanks, Cesar. I'll use the opportunity to ask one last question. Just in terms of your rest of Africa strategy, are you looking to expand further? What is sort of the status quo on that side?
Casper, is it okay if we give that to Ian?
Yeah.
Ian, yeah,
sure.
Repeat the question, yeah, but I think you heard it.
Thanks, Portia. Yeah, no, I think we've remained consistent in the communication of our rest of Africa strategy. There are certain countries where we believe we would benefit from further scale. There are one or two others where we are considering exit, so it's not entirely a one-size-fits-all answer. It's very much a country-by-country specific piece of thinking on essentially the more attractive markets versus less, and the places where we already have significant presence versus other. I mean, broadly speaking, you can think about SADC as being, from our perspective, largely mature with very dominant market shares in market, and East and West Africa has been areas where we need to do further work, both to grow and to optimize in specific, with country-specific lenses on that conversation. We have not disclosed the specifics of that for obvious reasons. One doesn't want to set hairs running around markets that you're considering not being in the long term. Thanks.
Thanks, Ian. Just go through the one last time. Are there any more questions for the team? Okay, I don't see any further hands. So without wasting any more time, then thank you everybody for attending the call today. Please feel free to reach out to us through the investor relations team or via the debt advisor, which is Nedbank Corporate and Investment Banking, and we'll be happy to answer any further questions you may have. And those of you who have requested one-on-one meetings, we will be meeting with you on the 8th of June. Thank you.
Cheers, everyone.
Thanks, everybody.
Thank you.
Thanks.